Okay, super. Hey, thanks guys for coming and taking a look at this special video. I know you're going to love it. And at the end, I'll give you kind of the inside track on how to get a Fusion membership, access to Fusion, and all five of the management techniques for only $10. Okay, so let's take a look here. This is what to expect. The money net is a trade that Mike and I showed you here on May 15th, 2014. That can pay you twice. Tomorrow, the 16th of May, he'll be likely taking a second credit from it. There's 5 different ways to play it, and I'm not sure which of them it's going to be tomorrow. It pays you to open this trade. It may pay you again when you close it, and it's likely that you'll get a higher premium with it than you would with a covered call trade. So there's 5 ways to take a second credit, and I'm not going to go through all of them because that's not the purpose of today's video. I'm going to show one of you, one of them to you. But first, a reminder of how income method number 5 works. You own stock. That stock is protected by a put option in a protective put or married put position. Okay, and then with that in place, then we do income method number 5. Income method number 5 is where you buy one call and sell 2 against it. In this case, when my stock was trading at 88.15 with Lululemon, I was able to sell to open 2 April $90 calls at $2.90 a piece, and at the same time purchase one April $85 call for $5.60, and that credit generated twice. The 2 times $2.90 equals $5.80. I spent some of it to pick up the long call, and so am left with a net credit of 20 cents per share. Now, the exciting thing about the ratio call spread is that you get paid on the front end if you set it up like I showed. Okay, if you set it up correctly, you get paid on the front end, but you may get paid again later as that stock moves or doesn't move. But later on, you have the opportunity to get a second credit. The problem with ratio call spreads is the unlimited upside risk. You know, if your stock goes up and you're naked on one of those calls, you could get in trouble. But didn't I say it was going to be riskless? Yes, you can do the ratio call spread risklessly if you do it in the context of owning the stock. Okay, I know that most folks are not clear to trade naked calls, and neither should they be. All right, most folks shouldn't be naked, but the unlimited upside risk goes away if you have the stock on hand. You know, the risk that's associated with it comes from selling an obligation, you know, giving yourself an obligation and no control over where the stock is going to go. But what if you do have the stock on hand? Well, the ratio call spread then does not insert into this trade that you already have in place, does not insert any capital risk, but you can take advantage of the benefits. So it's risk-free if you own the stock and you have sold no more calls than you have 100 share lots or long calls or long calls plus 100 share lots. Understand? You need to take a credit for this to be risk-free. If you do this at a debit, which you can buy one call and sell 2 against at a debit, that would insert risk, and that's not what we're aiming to do. So you just simply stand aside and don't do the trade unless you are able to do it at a credit. Okay, now that we've reviewed how to put on income method number 5, sell 2 calls and use some of the money to buy one, okay, there's 3 ways that the underlying stock can go afterwards. It can go up, it can go down, and sideways. Okay, that's it. And there's 5 different ways to manage this play, but I'm going to show only the one that I promised. Okay, so let's say that the stock goes up. Your management play is to close one of your shorts. Remember, you bought one long call and sold 2 against. You're going to close one of the shorts and you're going to cash in your bull call spread. Opening the trade went like this. The stock was at 88.15 and I sold to open 2 April 90s at $2.90 a piece, so that's $5.80 in. And then buy to open 1 April $85 call at $5.60, so it's $5.60 out, and now we have a net credit for setting the money net, the little money trap here, in place of 20 cents. Okay, now the stock went up, and this is the management play to close one short. The stock ended up being at $93.28 at expiration. So on expiration Friday, the combination of what we have here, we have one long call at 85 and two short calls at 90. When I close one of those short calls, what's left is the one long at 85 and the one short at 90. See that? So there's a bull call spread, and it's going to close in the money because it's expiration Friday after all, and the stock is at 93.28. All right, what have I got to do to hang on to my stock? Well, I've got to buy to close one of those April $90 calls, and it's $3.28 in the money, but I had to pay $3.50. Why? Because the market maker wants his. Okay, so that's $3.50 that I'm spending for a guaranteed $5, because in the middle of the night, my broker buys shares of Lulu at 85 and sells shares of Lulu at 90 on my behalf. I don't have to do anything. So the second credit for closing income method number 5 here is captured of $1.50. It's a net credit for closing it. Okay, so here's a summary of the benefits. Number 1, the money net pays me 20 cents to open. Number 2, in this scenario, another $1.50 net credit is collected for closing the short that prevents my stock from being assigned, and cashing in the bull call spread that I've been paid to own. Okay, now the stock had been at $88.15 and it went to $93.28, so that is an over $5 gain. My put that's protecting the stock goes down a little bit in value, but that loss is offset by the $1.70 gain in the money net, and of course the $5.13 gain in the stock. Okay, so overall, this is a great place to be in. We've captured $6.83, and the put has by no means gone down by that much. Okay, now why is this better than selling a covered call? Income method number 1. Well, if at the same time I had made the decision to do the money net play, if I had simply done a covered call play, yeah, I would have captured more premium up front. I would have got $2.90 instead of 20 cents. Okay, but buying to close would cost the same amount. If I want to keep my stock, it would cost the $3.50 that I spent on the expiration Friday to keep my stock, and so that's a 60-cent debit. Well, the 60-cent debit is okay if my stock has gone up by more than $5, which it did. But wouldn't you rather be paid $1.70 to be sitting on it during that time? That's the power of the money net. Okay. Now, I could go into other examples, okay, where we do other management plays, but I'm not, okay. This is for blueprint owners only to know all 5 income methods. Management techniques. There's 11 income methods, and this particular one, the money net, is income method number 5, nicknamed the money net. Okay, and you've got to own the blueprint in order to have all 5 management methods. But we have a special video in the Fusion members only area where I go through all 5 of those management techniques in great detail. Normally, a month of Fusion is $69. It's only $10 for a month of Fusion, which includes looking over the shoulder of our radioactive traders. Mike Chepka, tomorrow, it's May 15th today. Tomorrow is May 16th, 2014. It's expiration Friday, and he has a money net play in place, and you'll see, if you happen to have a Fusion membership, you'll see what he does tomorrow live. Okay, so also for blueprint owners that pick it up after watching this video, there's a free consultation with me, unlimited email support, and 100% money back guarantee. Go to this link, radioactivetrading.com/iridium, IRIDIUM, for 5 bonuses, including this Fusion membership for only $10 trial. Okay. All right, thanks for your time. Probably you'll want to go through this video more than once to really get it. So, and I've got to remind you that you alone are responsible for making your trading decisions. We're not recommending any kind of buying or selling of Lulu stock or Avis stock, uh, but we are showing a viable trading technique. Okay, if you have questions, hit us at support@radioactivetrading.com. And I'm Kurt Frankenberg, signing off for now. Thanks for being here today.